main headline grabber this week, so far as the news is concerned, is likely to be the latest World Economic Forum in Davos, Switzerland, when politicians, central bankers and company bosses will get together to discuss the big issues of the day. Now frankly, I wouldn't open the curtains if it was taking place in my back garden, and I'm not sure if it's of huge relevance looking at it through the admittedly narrow prism of financial markets. Now of much greater import, in the near term at least, are likely to be the latest interest rate decisions from the Bank of Japan on Tuesday the 21st of January and the European Central Bank on Thursday the 23rd, even if neither is actually expected to alter interest rates at all. Now lest we forget, the Bank of Japan's headline borrowing rate is minus 0.1% and the ECB's is 0. Neither seems in a hurry to tighten policy and raise rates, with the result that this isn't likely to be the most exciting chart you've ever seen. However, do remember that both the BOJ and the ECB are still running quantitative easing or QE programs too. Japan's is running at 80 trillion yen a year, the equivalent of £557 billion a year, more than the Bank of England's done in the last decade, and the ECB is buying bonds at the rate of 20 billion euros a month. It restarted QE last September, just as Mario Draghi stepped down and Christine Lagarde took the helm. Again, no change is expected in QE policy, although whether QE and low interest rates are working or not remains open to debate. Inflation is below the 2% target in both Japan and the EU, and growth's pretty patchy for good measure. And this is despite the fact that the Bank of Japan's bond purchases now equate to over 100% of GDP, and the ECB's around 40%. The Bank of England's QE scheme works out somewhere between a quarter and a fifth, if you'd like to know. Make of all of those numbers what you will. Now on the corporate front, we have a clutch of results releases and trading statements from FTSE 100 and FTSE 250 firms due in the coming week. They include mining giant BHP Group on Monday the 20th of January, airline EasyJet and retailers SSP and Dixon's Carphone on the 21st, luxury goods leader Burberry and software specialist Sage on the 22nd, online fast fashion retailer ASOS on the 23rd, which is actually AIM quoted, and brewer to pubs group Marston's on Friday the 24th. But for all of those, perhaps the big stock most capable of causing a fuss in the week ahead is miner Anglo American. The FTSE 100 member will release a fourth quarter production update on Thursday the 23rd of January. Now as we can see here, shares in the diamond, copper, coal, iron ore, palladium and platinum producer are up by nearly a fifth over the past 12 months. That's pretty good compared to the FTSE 100, which is up by around 10%, and also the Bloomberg Commodity Index, which is advanced by barely 5%. Like a lot of miners, and for that matter commodity prices, Anglo American started the year pretty badly, but then rallied hard in the second half, helped by hopes for strong economic growth in 2020, thanks in turn to central bank interest rate cuts and the trade talks between America and China. In this next chart, we can see how the headline prices of Anglo American's main outputs fared in 2019. Palladium and platinum were strong, thanks in part to power outages in South Africa and the after effects of the ongoing diesel car emissions scandal. Iron ore rallied after a mine accident in Brazil took up some capacity, at least temporarily, while copper again in the second half thanks to hopes for an upturn in China. But coal and diamonds were weak, with coal suffering at the hands of gathering environmental concerns and calls for more concerted efforts to move away from fossil fuels. This update will be important as Anglo American comments on production growth for 2019. Remember, at the 9-month stage, metallurgical coal output was up 2% with a 22% surge in Q3. Copper was down 1% after an 8% drop in the third period. Platinum was down 1%, palladium was broadly flat. Iron ore was down 7% after a flat Q3. Thermal coal was down 10% after a much bigger fall in the third quarter, and diamonds were down 12%. Now, Mr. Cutifani may also comment on other performance targets that he's laid out. These include total unit cost reductions of 5% in 2019, total production growth of 3% for 2020 as part of a plan to boost total output by 20 to 25% by 2023, with the Peruvian Quellaveco copper mine, a Namibian diamond project, and the Aquila metallurgical coal mine in Queensland, all big contributors there. And then finally, the generation of between $3 and $4 billion of additional EBITDA, earnings before interest, taxes, depreciation and amortization, between 2017 and 2022. Now in 2017, by the way, EBITDA was $8.8 billion on an underlying basis, so that target implies growth of 35 to 45%. On the strategic side of things, Mr. Cutifani may comment on the putative bid for Sirius Minerals and the ongoing $1 billion share buyback scheme, which is due to conclude by March. Alternatively, he may wait, at least on the buyback, until Anglo's full year results, which are due on the 20th of February. Thank you for watching, and I look forward to seeing you next time.